Hi, welcome to my channel. I'm not your financial advisor. This is for education and entertainment only. The stock market is risky. You can win big, but you can lose big too. The ideas here are just ideas. Do your own due diligence. You're the CEO of your money. The decisions and consequences are yours. Consult a real licensed financial professional before making big moves. Past performance doesn't guarantee future results. The market is wild and unpredictable. Strategies and data help, but the future is unwritten. Economic shifts, new leadership, global events, anything can change the game overnight. Stay humble, stay diversified, and never invest money you can't afford to lose. This is your financial future, not a game. The info here is current as of uploading this video, and things change fast. Today's hot stock could be worthless tomorrow, so keep learning. Your education as an investor never ends. Now that we've got the serious stuff out of the way, let's get to the good part. Let's talk strategy. What's the secret weapon for smart investors? It's called dollar cost averaging, DCA, and it's one of the most powerful tools you can use to build wealth over time. The concept is simple. Invest a fixed amount of money on a regular schedule, regardless of what the share price is doing. Rain or shine, up or down, you stick to your plan. Think of it as putting your investments on autopilot. You don't have to constantly watch the market or stress about when to buy. The real magic is in consistency. Set it, forget it, and let your investments work in the background while you focus on living your life. DCA takes the emotion out of investing. No more panic buying when prices soar or selling in fear when markets drop. You stay calm and collected. By investing the same amount each time, you naturally buy more shares when prices are low and fewer when they're high. This helps you take advantage of market dips without even trying. Over time, this strategy can lower your average cost per share, making your money work harder for you. Imagine putting $100 into your investments every single month. When prices drop, you scoop up more shares. When they rise, you buy a little less, but you never stop. Suddenly, volatility isn't something to fear, it's your friend. You're buying more when things are on sale, and that can really pay off in the long run. DCA is tailor-made for long-term investors. It's not about getting rich overnight, but about building a solid foundation for your future. It's about growing your wealth, slowly, steadily, and with confidence, one step at a time. DCA smooths out the bumps in the market and keeps you from falling into the trap of trying to time your buys and sells. The truth is, nobody, not even the experts, can consistently predict the market's next move. So why stress? Use DCA and let time and the magic of compounding returns do the heavy lifting for you. It's a strategy designed for real, lasting wealth. Wealth that can support your dreams and your family's future. Whether you have $50, $500, or even more to invest, DCA works for everyone, no matter your starting point. It's not about luck or guessing right, it's about discipline, patience, and sticking to your plan. The market will always have its ups and downs, but DCA helps you ride out the storms and stay on course. Instead of fearing volatility, you can make it work for you, turning uncertainty into opportunity. That's the beauty of dollar cost averaging. It's your secret weapon for building wealth no matter what the market does. Now you know how to invest. DCA, or dollar cost averaging, is a powerful way to build wealth over time by investing consistently, no matter what the market is doing. But the next big question is, what should you actually buy with your hard-earned money? The classic debate in investing circles, should you pick individual stocks or stick with index ETFs? Individual stocks mean putting your money behind a single company, like Apple, Nvidia, or whichever business you believe will outperform the rest. If you pick a winner, the returns can be massive, sometimes life-changing. You get to ride the wave of a company's success. But remember, the risk is just as big. If that company stumbles, your investment can take a serious hit. Index ETFs, on the other hand, are baskets of stocks that track major indexes like the S&P 500 or the NASDAQ. In general, the stock market tends to rise over the long term. When you buy just one ETF, you instantly own a small piece of hundreds, sometimes thousands of companies, giving you instant diversification and spreading out your risk. With individual stocks, you're like a sniper, carefully aiming for that one big win, hoping your research pays off. With ETFs, you're more like a strategist, spreading your bets across the entire market, aiming for steady, reliable growth. Stocks can offer explosive potential, but they also come with the roller coaster of big ups and downs. Sometimes more than most people can stomach. ETFs, meanwhile, offer steadier, more predictable growth over time. Less drama, less risk, and often less stress. Neither approach is better for everyone. It really depends on your personality, your risk tolerance, your goals, and how much time you're willing to spend researching investments. Do you want to chase those big wins and able to stomach market volatility? Or are you more comfortable with steady long-term growth? Are you ready to dive deep into research and follow the market closely? Or do you prefer a simpler, more hands-off approach? That's the real question to ask yourself. Both paths can help you build wealth over time. Just make sure you understand what you're investing for and choose the path that fits you best. How does DCA work with stocks versus ETFs? DCA into a single stock means you're making a long-term bet on one company. If you pick a winner, every dip is a chance to buy more at a discount. But if the company fails, you're just averaging down into a loser and could lose all your investments. The risk and reward are both concentrated. DCA into an index ETF is different. You're buying the whole market. Some companies will win, some will lose, but the index adapts over time. Diversification smooths out the ride. A bad quarter for one company won't sink your portfolio. You get the market's average return. Historically, that's been pretty good. You won't hit a home run, but you won't strike out either. It's the ultimate slow and steady wins the race strategy. Let's break down the pros and cons of dollar cost averaging, or DCA, when it comes to investing in individual stocks versus index ETFs. Each approach has its own unique strengths and weaknesses, and understanding them can help you make smarter decisions with your money. For individual stocks, the big pro is the potential for massive gains. If you pick the right company at the right time, your investment could skyrocket. You're in control of your choices, and the payoff can be huge. There's a real sense of accomplishment when your research pays off and you beat the market. You might even feel a personal connection to the companies you invest in, which can make the experience more exciting and engaging, but the risks are real. One bad move or a sudden downturn and you could lose a significant portion or even all of your investment. It takes a lot of work, constant research, staying updated on news, and monitoring your portfolio regularly. It can feel like a part-time job. Most people, even professional investors, struggle to consistently beat the market over the long term. The pressure can be intense and mistakes are costly. On the other hand, with index ETFs, the biggest pro is diversification. Your money is spread across many companies, which helps reduce risk. One purchase gives you exposure to the whole market, or a broad sector, so you're not relying on just one company's success or failure. It's simple, low cost, and doesn't require hours of research or constant attention. You can invest and get on with your life. This makes it perfect for people who want to build wealth steadily, without making investing a second job or a source of stress. The downside? You're settling for average returns, matching the market instead of beating it. There's less excitement, and you might miss out on big wins. You won't get those explosive single-stock gains that can make headlines or change your financial life overnight. But you also avoid catastrophic losses, and your portfolio is more likely to grow steadily over time, even if it's not spectacular. It's a trade-off, safety and simplicity versus the chance for spectacular returns and higher risk. Both approaches have their place, depending on your goals. So, know your risk tolerance, your time commitment, and what you want from your investments. That's the real key to choosing between stocks and ETFs. So, what's the verdict? Stocks or ETFs? There's no one-size-fits-all answer, and that's what makes investing so personal and interesting. The best strategy depends on your goals, personality, and risk tolerance. What works for one investor might not work for another. Love the thrill and research? Try picking stocks and dive deep into companies you believe in. Want steady growth with less stress? Go with index ETFs for broad market exposure and peace of mind. Or do both. Use ETFs as your core, and pick a few stocks for extra upside and excitement. The most important thing is to have a plan, stick to it, and review it regularly as your life changes. DCA works because it makes you consistent, not perfect, and helps you build wealth over time. Don't let indecision keep you on the sidelines. Start building wealth now, even if it's just a small step. Are you team stock or team ETF, or maybe a bit of both? Let me know in the comments below what you prefer. Hit like, subscribe, and let's invest safely and build our wealth together.